Okay, let's just dive right into this explainer and tackle what might honestly be the ultimate beginner investing standoff. If you've ever stared at your bank account and just wondered about the absolute best way to put your hard-earned money to work in the market, well, you're in the exact right place, because today we are finally settling a massive, massive debate.
So the core question we're looking at today is this. Should you invest steadily, week by week, month by month, or should you hold on to your cash and wait for the market to take a massive plunge so you can buy everything on a steep discount? It's a question that creates this huge procrastination trap. Honestly, the sheer fear of making the wrong move paralyzes so many people that they end up doing absolutely nothing at all. They just leave their money sitting on the sidelines, literally getting eaten alive by inflation.
Moving right along to Section 1, the classic investing standoff. Consistency versus timing.
First up in the ring, we've got dollar cost averaging, or DCA for short. Now, this is where you invest a fixed amount of money at very regular intervals, and you just totally ignore what the market is actually doing. Up, down, flat, doesn't matter, you just buy. Against that, we have buying the dip. This strategy has you hoarding your cash, basically acting like a sniper, right? You're just waiting for stock prices to drop so you can buy them on sale. And hey, buying the dip sounds incredibly logical. I mean, everyone loves a good discount, but it relies on this practically impossible task of recognizing exactly when a temporary decline has hit absolute rock bottom. I mean, is a 5% drop the bottom? What about 10%? What if you buy in and then it drops another 20%?
And that brings us to a closer look at dollar cost averaging. The true beauty of this strategy is right there in the name. Averaging. If you're automatically investing, let's say $500 on the first of every single month, this method entirely removes human emotion from the equation. When market prices are really high, well, your $500 naturally just buys you fewer shares. But when the market crashes and prices drop low, that exact same $500 automatically buys you significantly more shares. It builds immense discipline, completely removes the stress of trying to perfectly time the bottom, and it really stops you from endlessly procrastinating.
All right, let's look at Section 2, a tale of two investors. This is our micro test.
So both of our totally fictional investors here start the year with $6,000. Alex decides to use dollar cost averaging, so he's investing $500 every single month for 12 months. Jordan, on the other hand, wants to buy the dip. He holds all $6,000 in cash, stubbornly waiting for exactly a 10% market correction. Now, what's really fascinating here is what happens in the very first quarter. The market drops 8%. And Jordan? He gets completely trapped by this illusion of control. He just freezes. It's an 8% drop, sure, but he's waiting for 10%, right? So he does absolutely nothing, totally convinced the market's going to fall further. Meanwhile, Alex just keeps calmly buying, scooping up slightly cheaper shares along the way.
So as we move through the year, let's say a really good inflation report comes out mid-year, and bam, the market rapidly rebounds. It literally never hits Jordan's magical 10% target. By year-end, the market has trended upward. Jordan is incredibly frustrated just sitting on his big pile of cash that has done zero work for him all year long. Alex, however, steadily navigated all those ups and downs. By the end of the year, Alex is fully invested and has successfully captured the average growth of the whole market. Honestly, trying to perfectly time that mid-year bottom is nearly impossible, and Jordan really paid the price for trying.
Which brings us to Section 3, the 20-year market study. Let's look at the macro test.
To see how this plays out on a massive scale, Schwab tracked the market from 2003 all the way to 2022. They looked at 5 very different hypothetical investor personas. Every single persona was given $2,000 to invest annually into the exact same thing, the S&P 500. And I absolutely love this study because that $2,000 annual investment perfectly mirrors a normal person's routine retirement contributions. So let's see exactly how these varying strategies played out over 2 whole decades. Okay, let's look at the winners and losers here. First, we have Peter Perfect. Now, Peter has a literal time-traveling superpower. He somehow managed to invest his $2,000 at the absolute lowest bottom of the market every single year for 20 years straight. He is the ultimate totally impossible dip buyer, and he finishes with over $138,000. But look right next to him. Matthew Mundley is our completely boring DCA investor. He just split his $2,000 into 12 equal monthly payments. Despite never trying to time a single dip and, without needing a literal time machine, Matthew finished with over $124,000. He got incredibly close to the magical time-traveling Peter Perfect purely through emotional consistency.
Now, you might have noticed Ashley Action actually snuck into second place there with $127,000. Ashley's strategy was lump sum investing. She just threw her entire $2,000 into the market on the very first trading day of the year, every single year, without even a second thought. Historically, getting all your money into the market as early as possible actually performs the absolute best just because it has more time to grow, but DCA ranks a remarkably close third, balancing that reliable consistency with the real psychological safety net of averaging out your purchase prices.
But the absolute crucial takeaway here is this staggering number, $44,130. That is how Larry Linger finished the 20-year race. Larry was the ultimate procrastinator. He just stayed in cash, endlessly waiting for that perfect, gigantic market dip that never quite seemed to align with his expectations. This absolutely pathetic finish is the ultimate, very real cost of waiting on the sidelines for a perfect moment that simply does not exist.
Let's jump into Section 4, Mastering Your Investing Mindset, Psychology over Strategy.
So let's map out what I like to call the dip buying trap. Because everyone boldly says, oh, I will definitely buy when the market crashes, right? Step 1, you wait. Step 2, the terrifying drop actually happens. But here is exactly where the trap snaps shut at Step 3. When the market is bleeding, panic entirely replaces your logic. The news is screaming that the world is literally ending, and instead of greedily buying, people just freeze in absolute terror. Or even worse, they sell everything. By the time they finally calm down at Step 4, the market is already rebounded and they've missed the boat entirely. Dollar-cost averaging completely bypasses this mental short circuit.
Of course, nothing in finance is purely black and white. Many smart, long-term investors build their portfolios on a really strong DCA foundation. They automate their consistent investments, basically treating it like a superpower that builds immense discipline over time. But they might also keep a small, strategic cash reserve on the side. This is just money ready to be deployed only during a massive, undeniable market correction. The key here is balance. You can't wait endlessly, but keeping a little dry powder isn't necessarily a bad thing, as long as your main wealth-building engine is always running on autopilot.
To truly anchor today's explainer, let's look at some wisdom from the legendary investor himself, Warren Buffett. For the vast majority of people, the smartest thing to do is consistently invest in a low-cost index fund. Notice that Buffett isn't telling average folks to sit there, obsessively watch charts, and try to buy the dip. He's advocating for pure, unadulterated consistency. The underlying truth to everything we've looked at today is that your psychological mindset is just as important, if not way more important, than the granular mechanics of your strategy.
So, I want to leave you with this final provocative question. Look at your own accounts today. Look at your own habits. Are you going to keep making excuses, acting like Larry Linger, and continuously waiting for the perfect dip? Or are you going to start building unstoppable discipline by putting your money to work today? Stop trying to time the market and start putting your time in the market. Thanks so much for joining me for this explainer, and